Well, good evening, everybody. My name is Ed McClements. I'm a tax planner and realtor. And tonight, I just want to welcome you and thank you for joining us. You're experiencing a new type of video conferencing or webinar that gives us a chance to get introduced to this company, this product, Zoom.us. I want to thank you each for downloading that application. We've been using it now for a number of weeks, and it's really been a pleasure to use. It's kind of very much like Skype, but it's a much higher quality, and it allows you to have like up to 10 participants. So if you have a family with a number of people in different locations, this is a way in which you can use this tool. And the great thing about it, when you use it as a family, it's all free. So with that said, I want to tell you that tonight it's my opportunity to really answer a question for all those families that are renting. I'm sure that many families that are renting would love to own if they could. However, it's very easy just to keep on doing what we're used to doing. But the unfortunate thing is that if we do that, we're going to keep on getting what we're used to getting. And as we're going to see in a few moments, the tax code is so severely weighted and penalizes those families that rent, and gives a major number of gifts to families that own their own home. We're going to get a chance to see that and identify that and better understand how, well, almost more than 50% of the American families currently are overpaying their taxes. We're going to look at a couple of the brief tax forms that everybody uses every year, and we're going to get a chance to see how you can reduce the taxes you're paying and maybe build significant wealth for your family in the future. It could mean early retirement. It could mean that education account that you're worried about for your children. So I've been doing this for more than 50 years. And truly my passion at this stage in life is we have actually over 14 grandchildren, is to see all my grandchildren and your grandchildren have the knowledge and motivation to become a homeowner, because that's going to spell all the difference in the world as to how secure their family unit is going to be for early retirement and having funds available for educating their children. Next, here's just an outline of, in the middle of the page, one of the things is it's saying that recently income tax rates went up about a year or two ago. And today's rate, if you're in the maximum tax rate for the federal government, federal taxes, and the maximum rate for California state taxes, your total rate would be shown right here, 51.9%. That means more, that more than half of the year of all your labor really is going back to the government in taxes, if you are in that tax percentage. But even the bottom percentage starts a federal tax rate at about 18%, state rate at about 6%. So even the lowest rate, it may be as much as 30% or more. Other points are on this page that you can review. What I'd like to look at next is just to identify there's really 4 different types of income. The first one in the red column here is saying earned income. That's if you're an employee, you have a W-2 at the end of the year, that's all earned income. And you're going to pay federal taxes, state taxes, and even Social Security taxes. So that's could be as high as the 51.9% plus another 7 or 8% for Social Security tax. Column number 2 is passive income. This is where you may have bought something and then sell it, for a profit. And if you owned it for less than a year, that would be passive income. There wasn't any employment with it. So you still pay the full federal and state income tax rates, but no Social Security tax, at least on that. The next one is portfolio income, and that's where we own some stocks, mutual funds, and that type of tax rate is called capital gains. And previously, it was very low. It was down as low as 15%. You would have to pay tax on an investment like that you had owned more than a year and sold. But recently, that 15% was now put on a sliding scale. So depending on how much profit you actually made, that rate goes from 15 all the way up to 20%. And then to pay for the newest health insurance for our country, there is a 3.8% investment tax on top of it. So that's heavily taxed. Well, one column is in green. It's a good reason that we color it that, is that it is the only single area in the tax code where you pay no income tax, no state tax, no federal tax, no capital gains tax. This is strictly on the profit of a home that you've owned, lived in for 2 years or longer, and then sell. An interesting fact here in California is that the average homeowner, and this has been pretty standard for the last 20 years or more, the average family in California sells their home every 7 years. That's the average. Some people are getting a bigger home. Some people want to get that profit because in 7 years, at a 7% rate, that house may have gone up a substantial amount. So it may be for that reason, or some people are downsizing. Kids are grown, they need less room, and they want a new house. Maybe they want to be closer to the beach. Maybe they want to be in a senior citizen community. For any of those reasons, or all of them, people sell their homes. Well, there's a brand new tax law that most people are uninformed about. People think in terms of the old law that this one replaced. Previously, if you sold a house, made a big profit, if you did not invest it in a brand new, bigger home, you had to pay tax on it. All that's gone. That's old law that no longer applies. The newest law is called Internal Revenue Code 121. It's a tax exclusion. The rich people force this law through Congress with their children as representatives. And it simply says that when they sell their homes, $1 million homes, the first $500,000 that they make in profit is completely free of state, federal, and Social Security taxes. And they can do it over and over again. Well, we need to know about that because that makes a huge difference on the net worth for your family in the future. Let's just do a summary here. I have a little website that I put together that tries to give more input on this, and the name of the website is simply leaseknowmore.com. And let's look at the objectives that we want to cover in the next few minutes. We want to look at the reasons that it's better to be a homeowner. Why is it's because primarily that people that own a home have a much higher net worth than renters. You're going to see a fascinating statistic which just came off of a Google search in the last couple of days, and it traced the difference in the amount of net worth between homeowners and renters. And it says that the average during this 10, 12-year period, the average homeowner's net worth is 31 to up to 46 times larger than the net worth of a renter. We need to know that fact. That should be all the motivation that you need to do everything possible to see that your family owns a home and no longer continues leasing. The how of this answer is they build up more wealth as a homeowner strictly because they pay less taxes each year. We're going to look at that. And number two, we mentioned on the previous page that homeowners get up to $500,000 tax-free profit every time they sell their home. Well, how hard is it to buy a home right now? Let's look at those choices that you have. And I would say that 80 or 90% of the people that now rent could own a home in the next 30 to 60 days, just by knowing these choices that you have access to. Number one, let's consider just a conventional one. Maybe you have significant savings, you have a great credit rating, all of which you're going to need to get a conventional mortgage from a bank. And they're going to insist that you put down 10 to 20% down payment. So that's a lot of money. A $300,000 home, you may need to have $60,000 as a down payment. That certainly keeps an awful lot of people discouraged from being able to consider buying. They never can accumulate that kind of funds, but you still can own a home. Another point about the conventional bank, because interest rates are at a historical all-time low in the 3 to 4% range. Banks, I don't believe, really want to give out mortgages. They do everything they can to turn down people who apply. They would rather wait until the interest rates are much higher in the future years before they become more generous on accepting people and approving families for a conventional loan. Well, let's forget the conventional loan. How about using the Federal Housing Authority, which allows people to buy a home with only 3.5% down? That may be the answer. If you've been one of those individuals that have served our country and you're a veteran, you can buy a house today with a veteran's loan with only $0 down. And in some cases, even the small closing costs could be covered really by the seller of the property. Another new area to most people is this whole new area called an AITD. It stands for an all-inclusive trust deed. There you can buy a home, but you do need money. You do need to have a down payment. That down payment needs to be anywhere from 10% on the average, maybe a little bit less in some cases. The beauty of that is that you don't have to qualify when you make an AITD purchase. There's no credit score. They don't care what your credit score is, and there's no bank approval that's needed. How about all of you individuals that are self-employed and are disqualified by the banks because you don't have visible proof of taxable income? There may be more of a cash type business, and the cash flow is there, but you're not able to show it in the way the bank wants to see it for year after year of steady income. So you can use that AITD and buy a home and its current mortgage so that you don't have to qualify for one yourself. A last area, let's call it home partnerships. With what you see in a moment on the next couple of slides, you're going to see all the incentives that you'll ever need to realize how desperate the situation is in gaining assets for your family if you're a renter. It's almost impossible. And you're going to see that. If you're convinced, as everyone is when they see that information, you're going to do everything possible, whether it's a parent, a grandparent, a brother, sister, any relative that has assets. People with assets have problems right now. The bank is paying them less than 1% interest on their savings. Well, they can become a home partner with you. They can help you by gifting to you, let's say that 3.5% for the FHA. Maybe it's on $10,000, $15,000. You can agree in writing, and their money will be secured by the house that you're buying, that you're going to pay them 6, 7, 8% interest. which you easily can do from the profit that your home is going to generate because of appreciation. So a home partner, family members, an employer, just someone who wants to receive a higher rate of return than the 1% or less that the bank is paying. Uh, it's a win-win situation for someone who cares about you to help you do that. And this is almost an absolute necessity for grandparents with resources. Make sure your grandchildren have a home. You're protected and your income will be much higher by being a home partner with them. Here's the startling fact. I put down a title here, What a Difference a Deed Makes. And I hope you remember that saying, what a difference a deed makes. On this chart, and this came right off of Google's search in the last couple of days, so it's very current, and it simply says that the average homeowner today in the United States has a average net worth of $174,500. And that's probably much higher here in California. What about that family that's renting? The people that are renting are really less than a month or 2 months away from being homeless because their total net worth is $5,100. What is that? 1 or 2 months rent? Their income stopped. Their landlord, after 30 or 60 days, is going to ask them to leave. And there's nothing to fall back on. So you and I have to make decisions for our families. Which of these two groups are you going to fall into? Here's another way of seeing another chart that came from Google in the last couple of days. This chart is simply saying that the amount of net worth from 1998 through 2013 has really changed, but it's a multiple factor of anywhere from 31 to 46 times that of a renter. I mean, that's huge. What can we do to change that? Well, the first thing is to know another thing that you may want to search on Google search is ask your computer how many people in the United States overpay their taxes. You're going to be amazed. A huge percentage overpay their taxes every year. And it explains why. And this information on this slide tells you why. The government is very smart. They know that many of us will always take the simplest, easiest route to do and prepare our taxes. So they provide, and here we're looking at this year's 1040 that you'd file for last year's income. And those, the 1040, page 1 and page 2. And here they're saying, let's say you don't have any receipts. You don't want to be bothered. You want to do your taxes real fast. We're going to give you a standard deduction of $12,600, and then you don't have to do anything else. You just claim that, and we won't ever ask for a receipt at all. Sounds good, right? And that's what the average American family is doing. And last year, collectively, they overpaid their taxes by more than $1 billion. That's $1 billion overpaid to the government. What was missing in the return was the next page. This page, this is called a Schedule A. And here, by just filling out a few more lines, especially if you own a home, it gives you the right to be able to deduct 100% of your mortgage interest and your real estate taxes and all of your state income taxes, in addition to everything that you're giving to charities, all the donation of used things that you donated to Goodwill, all the money that you pay to your church. All of those things are added together And for many families, that deduction could equal well over 30, 40. In some cases, the maximum I've seen is close to $80,000 just for real estate interest and real estate taxes alone. So you choose. Page 1 and 2, get a $12,000 deduction, or itemize, own a home, itemize, and get a 30, 40, or $50,000 deduction from your gross income. That's big. That's how you'll pay less income tax each and every year. Number two is about that new tax law that I mentioned. New, it's been in force since 1968, I believe. And this publication right here will tell you everything about it. Okay. For any tax forms, all you have to do is go to your browser on your computer and put in irs.gov, G-O-V. And all the forms are right there. Type in a form number and it will give you that information. And this will tell you how every time you sell a home that you've lived in, all the profit on that house is yours. You walk out of escrow with a check of 100, 200, 3, up to $500,000. It feels like you're robbing a bank, but you're not. You're just getting something from knowledge. You can't get something in this world, something for nothing, but you can gain so much by having knowledge. And the attempt of this webinar really is to give you some of that information and motivation to go forward and learn more. I want to ask a question, and I mentioned it at the beginning of the webinar a little bit. What if your employer says, hey, you've been doing a great job for us, and we don't think we've been paying you enough, so we're going to give you a pay increase, an increase in take-home pay of $500 a month. Would that be enough for you to consider buying a home? Maybe the mortgage is a little bit more than you're paying in rent, but you're going to have $500 extra in your take-home pay every month. Okay, that's what a Form W-4 is for. Let's look at this form. Now, we've all seen it. This is not new to you because when you're hired, you have to fill that out. And page 1 is what we always see, just this front side. And it simply says, put down 1 because you're a person, put down another one here if you're married, and then put down a number for the number of children or dependents that you have. And in the example, we're saying page 1 on the W-4 that the individual maybe had a husband and wife and 2 children. So they were claiming 4 exemptions. What no one tells us, our tax preparers don't show us this. No one does. Your real estate agents, unfortunately, don't even show you this. But turn that W-4, once you get a printout from irs.gov, turn that over, and you'll see that not only do people get exemptions, but homes get exemptions. You can estimate in advance the entire amount that you're going to have as deductions for your home mortgage, for the real estate taxes you pay on your home, for the state income tax that you pay, for charitable deductions, for churches, the deductions that you make to your church every week. All of those are added together. And because we're itemizing here, we subtract from that gross total the $12,600 that was on the previous page. That's a standard exemption. We don't want that. We want what we're really entitled to. And once you get that total, it may be $40,000, $50,000. You then are told right in this section here, there's a number, it's about $4,000. Divide 4,000 into that whole balance that you've had for the year. And for every time the 4,000 will go into that larger number, that gives you a brand new exemption. It's not unusual for a home to give an employee an extra 5 exemptions because of all of those itemized expenses. Well, the form simply says that if you have deductions for your home and you have 4 exemptions for people, add them together and turn in the new form which says you now have 9 exemptions. What do you think that does to your take-home pay? It's going to increase it $400, $500, $600 per month. Could even be more than that. This is information that you needed to know. This is how the government helps you make a mortgage payment every single month. There are no deductions, sorry, for those of us that are renting. How to buy a home. The conventional, we talked about that. We talked about the FHA mortgage, the VA mortgage. Here's the all-inclusive trust deed. For purchasing a home is here. No minimum, no bank approval, no proof of income, no required debt ratios, and also consider that home partnership. All of those are good ways to do this. You have a decision to make. You're going to have to decide how long are you going to stay in this group and not move over here. This spells all the difference in good, safe retirement, a family with less financial stress because they have resources to be able to turn to in emergencies. Become a homeowner, and our job is to help you do that in any way possible. Here is just a summary of what my background is. It's important to know who are you speaking with and what kind of education do they have that qualifies them to give you this kind of information. Hopefully you'll find that we are well qualified for that. Here's our contact information. I want to encourage you to use our email address. Send us an email. Let us know. Contact us. Call us on the cell phone number right here. Let us sit down and find a path by which you and your family can move from being renters to owners. I want to thank you very much for spending this time with me, and I hope this is helpful. This is also, this webinar, we've recorded it, and we're glad to send it by email to any of you. So for yourself or family members who you want also to hear this information, please send us an email, request a copy of this webinar, and we'll be glad to get it over to you right away. In the meantime, thank you very much for participating, and I wish you, good hunting for a new home. Thank you very much. It's a pleasure to have a chance to share this information with you. How long was that, Carol?
32 minutes.